Okay, so I want to get a quick update. This is about 3 months after buying the place, and I was going to do a cash flow analysis, but I'm going to add the improvements I've done so far. So I just replaced the roof. I was able to claim it on a hailstorm that came through. So that was only the cost of the deductible, so not much. And then I just finished painting the whole house right before they're going to put on gutters. So everything will be painted behind it and protected for a few years. So I'm going to do a quick walk around and show what it looks like. So right now you got fresh paint and a new roof. I ended up using Sherwin-Williams super paint and a satin. Right now there's a paint shortage, so I was lucky to get it this time. For the trim I had to use Glidden Premium since the deep base wasn't available in the super paint. But it came out alright. It rolled nicely and brushed nicely, and the super paint sprayed really nice. Went on evenly and had a good spray pattern. There's also a shortage for shingles and the light colors, so I had to go the lightest I could. I think this is, they call it like tan or desert tan or something like that. This is a normal laminate shingle. I think it's Owens Corning's Oak Ridge. The update. So now I'm going to go over the numbers that I have so far. Here are the numbers that I have for the house. So to start off with, I purchased it for $195. It was worth about $218. It didn't really need any work on the inside, and it was fine to rent out as is. Put $15 down, so this was roughly $30,000. I had closing cost of $66.87. This includes title fees and the mortgage fees. This doesn't include prepaids or anything, so these are pure fees. For the rehab, I'm including $1,000 for the deductible and then $700 for paint and other miscellaneous stuff. This includes this stuff right here, so gutters, even though they ended up being replaced, doorknobs, peepholes, smart alarms. A lot of this stuff was for making it rent ready. So back to the numbers. My total cash invested at this point is $37,600. So this includes the down payment, the fees for the closing, and the rehab that I've done. So the loan after the 15 down was about $166. I ended up getting a rate of 3.85%. So here are the numbers for the payment. So taxes were $4,000 on this per year. Insurance about $1,800, and these are just the combined values. And a PMI of 54 since I didn't put 20% down. The payment comes out to $777 over a 30-year term. So for the rents, it ended up being higher than I thought at $1,650, so it rented out very quickly. There's a lot of applicants. So here's my PITIA. This is basically everything up here added together. So this comes out to $1,317. And as far as other expenses, I put 5% to repair. So this is based off of the rent amount. 5% as repair, 5% as CapEx. CapEx are large expenses like the average of a cost to replace a water heater or a roof or a HVAC system. So you basically take the lifetime of those items and get an average cost. So if a water heater costs $500, you take that cost and divide it by how long it should last, and then you get $50 a year for that. So this is just an average per month to cover that. And then property management, 10%. This is pretty standard across the country. Sometimes they add set fees, but most of the time it's a percentage of the rent. And then you have to include vacancy. So I'm assuming 2% vacancy. So that's a little over a month of vacancy per year. So to calculate the net cash flow, I take the total fees, subtract it from the rent, and I get a negative $162. So for a year, it's almost negative $2,000. So based on my amount invested, this is a really low and bad return on investment, so it's obviously negative, which is not good. If I project the rent increases, so rent will definitely increase in this market. I get a internal rate of return over 30 years of 6.22%, and it won't become positive until between year 5 and 6. So here's my estimates right here. So it's basically, I'm assuming a 2% increase. That should be fairly conservative. So it should increase faster than that depending on what happens with the market. And here are the balances of the loan and the equity that I have. This doesn't include appreciation of the house itself. This is only based on the loan. So not too bad for this market. This is definitely an appreciating market, not a cash flow market. Plus, I got over 20 grand as equity at the buy, which is always nice. So this is analyzing it as an investment, pure investment, where you put some money down and you get a set return. If I include everything else that comes with real estate, it becomes much better. So this is including appreciation, the pay down of the loan as the tenant pays you rent, and then the tax savings that I get for being able to deduct the depreciation, which isn't a real expense, but it's definitely a tax savings. So if I assume the market appreciates 10% a year, which it's done consistently for many years in my area, that's about 20 grand a year that my net worth is increasing. So it becomes an average of $1,800 per month. And principal pay down the first few years, you can see the numbers right here. So this is basically, these are months right here. So about $250 per month that the principal on that loan is being paid down. So the other thing is the tax savings that comes with it, since you could deduct your expenses as well as depreciation on the property. So the way the depreciation works is you take your basis of the property, which is basically the purchase price, you subtract out the land, since you can't depreciate land, and you end up with your building cost. You divide this, right now it's 27.5 years, and that's how much you could depreciate per year, since the government says that the building has a life expectancy of 27.5 years, and after that it's used up. In reality, that's not the case. So this is really just a bonus expense that you have that's not really costing you anything. I'm not a tax expert, but you could look this up separately to see how this works. So for this property, the basis is roughly $6,000 per year. So if I take my negative expense, and this is assuming that I actually have these expenses, and I add that $6,000, I end up with a negative about $8,000. So $6,000 plus this, almost $2,000. And since I get to deduct all of that against my income, and I'm in the 22% tax bracket, that represents almost $1,800 in tax savings by being able to deduct this. So if I calculate my new net, including everything, take rent minus all these expenses, but I add back everything that I'm gaining from it, including principal pay down, market appreciation, and tax savings, it ends up being a positive about 2 grand a month to my net worth. So if you consider that, the return on investment is obviously much higher compared to my total cash invested. And this market appreciation really helps out there. That's the majority of it right there, since that really offsets the initial cash invested. So that is the update on this house and the cash flow numbers. I'm only about my 3rd month in, but no issues so far with the tenants. They seem really nice and good people. So hopefully they stay and I continue to get these rents, and of course keep up on rent increases, keep up with the market, and this should be a good performing property. Thanks for watching.